Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today's Friday, May 29th. I feel with all the irrational exuberance that we've been seeing in the market, whenever that starts to happen, I try to do kind of a reality check. I check in with myself, and because it's always a split screen for me. And bull and bear, bull and bear. That's the way I see everything. I'm never an absolute bull or an absolute bear. It's always a series of probabilities. Right now, it's 65% bullish, 35% bearish, and it just swings. Sometimes it's 65% bearish, 35% bullish. I'm talking about sentiment. So where do we stand right now? First of all, you have to be flexible in this market. Very flexible. Whoa, you have to be flexible. I always have a rule: sell into irrational exuberance or take some profits. So if you see stocks that you own that have just, they've got up 50% or 100% in a week or a month or whatever it is, it's always been a discipline of mine to take some of that off the table because, as Warren Buffett has famously said, you pay a high price for a cheery consensus. And one of the things that bull markets do, it's really interesting. It lowers IQ points on people. It really does, because what's happening actually, chemically is your brain's releasing dopamine. You check your stock account, you see it's up, everybody's talking about it. All of a sudden, there's a lot of action going on, and you feel exciting and jazzed up, and you're in it, and it's all exciting, blah, 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 blah. So I find it the discipline of managing my money is to actually be able to look past that, to know that everybody's here and it's like a midnight or 1 a.m. at a party. Everybody's a little drunk. They're making drunk, hazy decisions. This is what is happening right now, full stop. So there are also 5 risks that I worry about that are stacking up underneath the surface, and I'm going to just quickly go over them. I'm not trying to rain on your weekend. I'm just trying to sober us up. Consider this the cup of coffee at the party. I'm certainly not a Debbie Downer. Come on. I know people who, they're always saying the sky's falling. I'm not one of those humans. I'm generally optimistic by nature. So 5 biggest risks to equities. Number 1, stocks are up. Great. But consumers are under a lot of strain. Look, searches for help paying your mortgage have never been higher. And it really reminds me of Plato's old quote, the old quote by Plato, that basically there's always, in every city, there are really 2 cities, one for the haves and the other city is for the have-nots, and these two are always at war. But there are a lot of Americans really struggling here, okay? It's crazy. And ultimately, never forget, consumer spending drives 70% of economic growth, 67% or thereabouts. Look at that. That's a big deal. Number 2, profits are strong, but the markets are narrow. 85% of the gains this year have come from 10% of the companies. Now, there's a couple of reasons for that. When people rattle off that statistic, I say that's true. That's factually correct. But these indexes have also been kind of ginned up to be tech heavy in a way, maybe even too much, which is leading to some of these crazy valuations. They're true indexes, but they're also marketing tools. It's kind of complicated. But yeah, it's narrow. You want to see the bull market broaden out because it implies that a bunch of investors are seeing more profit opportunities for a wider segment, which tells us a clue about economic growth across the country. This is very, very important stuff. When we say that this is a narrow boom, the danger is if it's too narrow, it doesn't spread across the country, it's not sustainable. Also, another risk, pricing is what's driving profitability. And this is something that really is important to know. When you have companies like Micron or, this company, that, these companies that are just going gangbusters, God bless them, a lot of them are not building their capacity, extra capacity. When a company does not build, like Seagate, does not build extra capacity, it says, you know what? What they're doing instead is they're ratcheting up prices, and they're telegraphing that we don't know if this is going to last for a long time. We think this is a 1 or 2 year cycle. Why would we build extra capacity, another factory or 2 or 3, and then have the hangover of that left to us when this ends? So this is, again, in the euphoria of the moment. Everybody's very excited, blah, 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 blah. I get it. But, I'm looking for them to start building extra capacity. factories, more places to build these chips. When they start doing that, that tells you that they believe it's actually more sustainable. It's a long-term shift instead of a demand pull situation where you're just pulling 7 years of demand into today or into the next 12 months. Very different dynamics. The demand pull situation where companies just pull forward demand for the future, they pull it into today or this year, that creates crazy booms. And it also creates crazy hangovers, okay? Crazy hangovers, think .com, okay? Also, another one, cost of capital is rising, okay? It's getting more expensive to borrow money. Now, think about this. Data centers are so expensive that you need to borrow money. This is how private equity is getting their slice. They're lending money to people building data centers. But if those costs go up, I want to borrow $10 billion to build a data center, and you are going to charge me X, and now you're going to charge me 1.5X, my goodness, is the project worth actually doing? Should I make it smaller? Blah, 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 blah. So you start asking, there's different math when the cost of the money you borrow goes higher. It just is different math, period. And I actually think it's good that the guys lending the money, the private equity shops and all that, are actually raising the cost of capital on these loans because they're trying to impose more fiscal discipline in the people with this gold rush mentality on data centers. They're saying, look, hey, look, we'll lend you money at 6-7% instead of 4 or 5% because we'll lend you if you could prove that you get us a return on that money. So you need a higher hurdle to jump over. But by far, the single biggest risk to equities, it's the bond market, the 10-year bond, period. Matter of fact, here's a little exercise for you. Check the 10-year bond yield first. And that'll tell you more about the direction of stocks that day than any other indicator, okay? The bond market drives the stock. It's gravity. And if that 10-year yield hits a certain ceiling, especially 5%, the market has just, can't go above it. But the market tends to rise when that bond market goes down. This is what is happening. You remember something. Bond yields and stock prices, inverse relationship. Yields go up, stock prices go down. Yields go down, stock prices go up. So again, I don't want you to enter your weekend here from listening to Debbie Downer. I'm not being a Debbie Downer. I'm just saying there's a lot of euphoria right now. A lot of euphoria, a lot of drunk drivers on the road, okay? You are driving around during New Year's Eve. That's what this is, okay? Just to give you an idea, okay? A lot of drunk drivers on the road, a lot of stupid people making stupid decisions. Don't be one of them.